For years, Enron seemed untouchable. Investors rushed to buy its stock. Politicians praised it as proof of American innovation. Business schools analyzed its strategy. Fortune magazine repeatedly ranked it among the country's most admired companies. Inside its gleaming headquarters, employees believed they weren't just working for another corporation. They were helping reinvent the future of business itself. From the outside, everything looked almost perfect. But beneath that extraordinary success, another story was quietly unfolding. It wasn't hidden in secret vaults or buried inside confidential government files. It was hiding in plain sight, inside financial statements, ambitious forecasts, and a corporate culture where appearances slowly became more valuable than reality. Years later, after billions of dollars had vanished, retirement savings had been wiped out, and one of the world's largest accounting firms had collapsed alongside its client, a haunting question remained. How could so many intelligent people, executives, auditors, analysts, regulators, and investors, miss what was happening right in front of them? The answer isn't simply greed. It's a story about ambition, innovation, psychology, and the dangerous moment when success becomes something a company can no longer afford to lose. Because Enron didn't collapse overnight. It unraveled, one decision at a time. And by the time anyone truly understood what was happening, it was already too late. The story begins in 1985. That year, two natural gas pipeline companies merged to create a new corporation called Enron. At first, there was nothing especially remarkable about it. Its business was straightforward. It owned pipelines that transported natural gas across the United States, earning reliable, predictable income. It wasn't glamorous, but it was stable. Then, America changed. During the late 1980s and early 1990s, the energy industry underwent deregulation. Instead of governments tightly controlling prices and distribution, markets became more competitive. Suddenly, energy wasn't just something companies produced and delivered. It became something they could buy, sell, hedge, and trade. For most businesses, deregulation created uncertainty. For Enron, it created an opportunity. And one man saw that opportunity more clearly than almost anyone else. His name was Jeffrey Skilling. Originally a consultant, Skilling believed energy didn't have to be treated like a traditional commodity. In his view, electricity and natural gas could be traded much like stocks, currencies, or bonds on Wall Street. It sounded revolutionary. Instead of simply transporting gas, Enron could become the marketplace itself. That vision captivated Kenneth Lay, Enron's charismatic chairman and later chief executive. Lay understood something beyond finance. Stories sell. Investors weren't excited by pipelines. They were excited by transformation. Together, Lay and Skilling began presenting Enron as something much bigger than an energy company. It would become a technology company, a financial company, a risk management company, a global innovator. In an era increasingly obsessed with the internet and disruption, it was exactly the kind of story Wall Street wanted to believe. And for a while, the numbers seemed to support it. Enron's trading business expanded rapidly. Quarter after quarter, the company reported impressive growth. Analysts praised its innovation. Financial television celebrated its executives. Investment banks eagerly competed to work with the company. Every positive headline reinforced another. Success attracted more investors. More investors pushed the stock price higher. A higher stock price made Enron appear even more successful. The cycle fed itself. Employees embraced the excitement. Working at Enron became a badge of honor. The company recruited some of America's brightest graduates, promising enormous bonuses and the chance to reshape entire industries. Inside headquarters, confidence wasn't merely encouraged. It became part of the company's identity. If you questioned the vision, perhaps you simply didn't understand it. But beneath all that optimism, another pressure was quietly building. Growth creates expectations, and expectations can become traps. Once investors believe a company can produce extraordinary results every quarter, ordinary performance no longer feels acceptable. Missing earnings estimates isn't just disappointing, it becomes dangerous. Because Wall Street doesn't merely reward growth, it rewards consistency. Even one disappointing quarter can erase billions of dollars in market value. Enron's executives understood that reality better than anyone. And gradually, the company became less focused on reporting success and more focused on never appearing unsuccessful. That subtle shift would change everything. One accounting method played an enormous role in making Enron's story look almost unstoppable. It was called mark-to-market accounting. On its own, this wasn't illegal. In fact, Under certain circumstances, accounting rules permitted companies to use it. But like many powerful tools, it depended entirely on how honestly it was applied. Imagine signing a 20-year contract today. Normally, a business would recognize revenue gradually, as payments actually arrived over those 20 years. Mark-to-market accounting worked differently. If future earnings could be reasonably estimated, much of that expected profit could be recorded immediately. Notice the key word, estimated. If those estimates later proved too optimistic, the earlier profits wouldn't magically disappear from investors' memories. They had already shaped stock prices, executive bonuses, and market expectations. The temptation was obvious. The more optimistic your assumptions became, the better today's financial results appeared. And today's results mattered enormously, because executive compensation depended heavily on reported performance. So did employee bonuses. So did investor confidence. The system rewarded optimism. Reality would have to catch up later. At first glance, it looked brilliant, but investigators would later argue that this accounting flexibility gradually became something much more dangerous. Not because the method itself was fraudulent, because human incentives were. Imagine being told your career depended on producing exceptional numbers every 3 months. Now imagine admitting a project isn't going as planned. Would you present the worst-case scenario, or the most optimistic one you could reasonably defend? That question wasn't unique to Enron. But at Enron, the stakes were unusually high. The company fostered one of the most competitive corporate cultures in America. Employees were constantly evaluated against one another through a system often described as rank and yank. Those who ranked near the top received enormous bonuses. Those near the bottom risked losing their jobs. Competition produced impressive results. It also produced fear. Fear changes decision-making. When careers depend on appearing successful, people naturally become reluctant to admit problems. Optimistic forecasts become easier. Bad news travels more slowly. Warnings become uncomfortable conversations, and uncomfortable conversations become increasingly rare. No one needed to issue a written order saying, "Hide the problems." The incentives often spoke loudly enough. Over time, the culture itself began rewarding confidence more consistently than caution. That may have been one of Enron's most valuable assets during its rise. It also became one of its greatest weaknesses. As confidence grew, so did ambition. Enron expanded far beyond natural gas. It entered electricity trading, then broadband, then weather derivatives, then international infrastructure projects, then businesses so complex that many experienced investors struggled to explain exactly how they generated profits. Some of these ventures were genuinely innovative. Others never produced meaningful returns. But from the outside, distinguishing between the two became increasingly difficult. And strangely, that complexity often worked in Enron's favor. People tend to associate complexity with expertise. If a business seems impossible to understand, many assume it must simply be operating at a higher level. Analysts repeated management's explanations. Television celebrated innovation. Investors continued buying shares. Few wanted to admit they didn't fully understand the company. After all, if everyone else seemed convinced, perhaps the problem was your own lack of expertise. That psychological trap would prove remarkably powerful, because the more complicated Enron became, the fewer people felt comfortable asking basic questions. Questions like, where exactly is the cash coming from? Or, why do reported profits keep rising while cash flow tells a more complicated story? Those questions existed, but for a long time, they remained surprisingly quiet. Then another key figure entered the center of the story. Andrew Fastow. As Enron's chief financial officer, Fastow was responsible for helping manage the company's finances. He was also exceptionally creative. Perhaps too creative. Fastow designed a network of entities known as special purpose entities, or SPEs. On paper, these partnerships serve legitimate purposes. Businesses often create separate legal entities to isolate financial risk or finance specific projects. Used correctly, they're entirely legal. But according to later investigations and court findings, some of Enron's SPEs served another purpose. They helped move debt away from Enron's own balance sheet. Poorly performing assets could be transferred into these partnerships. Liabilities became less visible. Financial statements appeared healthier. Investors saw a company carrying less debt than its underlying economic reality suggested. Even more troubling, Fastow personally managed some of these partnerships, while simultaneously serving as Enron's chief financial officer. That created an extraordinary conflict of interest. He was effectively negotiating transactions involving both sides of the deal. Certain arrangements had received internal approval, but critics later argued that meaningful independence had disappeared. The accounting appeared increasingly sophisticated. The risks became increasingly hidden. And as long as Enron's stock price kept climbing, few people wanted to challenge a system that seemed to be working. But hidden inside those partnerships was a weakness that depended on one fragile assumption, that Enron's stock would keep rising forever. It wouldn't. And when that assumption finally broke, everything built upon it would begin to unravel. What almost no one outside Enron realized was that many of those carefully engineered financial structures depended on a single thing: confidence. Not cash, not profits, confidence. As long as investors believed Enron was one of America's brightest success stories, its stock price remained high. And as long as that stock price stayed high, many of the company's complex partnerships continued functioning exactly as intended. It looked like a self-sustaining machine. In reality, it was becoming increasingly fragile, because once confidence began to crack, the entire structure would come under pressure at the same time. And the first crack didn't come from a government investigation. It came from a simple question. In early 2001, financial journalist Bethany McLean was researching Enron for Fortune magazine. She wasn't trying to expose a fraud. She was trying to understand one of America's most celebrated companies. The deeper she looked, the more puzzled she became. Enron reported remarkable profits. Its executives spoke confidently about innovation. Analysts praised its business model. Yet one basic question remained surprisingly difficult to answer. How exactly does Enron make its money? It sounded almost too simple. This was a company worth tens of billions of dollars. Surely the answer should have been obvious. Instead, executives responded with explanations that many observers found unusually complicated. Complexity isn't proof of wrongdoing. Some businesses really are difficult to understand, but complexity can also discourage scrutiny. And McLean's question planted an uncomfortable seed. If one of Wall Street's biggest stars couldn't clearly explain its business model, what else might investors be missing? Around the same time, concern was growing inside Enron itself. One executive in particular decided she could no longer stay silent. Her name was Sharon Watkins, a vice president at Enron. Watkins sent Kenneth Lay a confidential memo warning that the company's accounting practices could eventually destroy everything the company had built. She feared that hidden financial problems would become public and trigger devastating consequences. The memo wasn't dramatic. It didn't predict the exact day Enron would fail, but it documented something important. Someone inside the company had recognized that the risks were no longer theoretical. Years later, that memo would become one of the most significant pieces of evidence in understanding what senior leadership knew before the collapse. Yet despite the warning, the underlying problems remained. Business continued. Public confidence largely held for a little while longer. Then the market began doing what markets always do. It asked harder questions. Enron's share price started slipping. Normally, a declining stock price is painful. For Enron, it was potentially catastrophic. Many of the company's partnerships relied on Enron shares to maintain their financial strength. As the stock fell, those arrangements required additional support. That created new pressure. New pressure weakened investor confidence. Lower confidence pushed the stock even lower. What had once been a powerful cycle of success suddenly began operating in reverse. Every decline created another problem. Every problem increased uncertainty, and uncertainty spread much faster than optimism. Then came a decision that shocked Wall Street. In August 2001, Jeffrey Skilling unexpectedly resigned as chief executive after only a few months in the role. His official explanation was personal reasons, but investors couldn't ignore the timing. Skilling wasn't just another executive. He had been one of the principal architects of Enron's transformation. If he believed so strongly in the company's future, why leave now? The announcement fueled speculation almost immediately. Analysts began asking tougher questions. Reporters intensified their investigations. Regulators watched more closely. Confidence, the very thing Enron depended on most, was quietly slipping away. And once trust begins disappearing, restoring it becomes extraordinarily difficult. Only weeks later, the company disclosed billions of dollars in reductions to shareholder equity connected to previously undisclosed partnership transactions. Suddenly, issues that had once seemed technical became impossible to ignore. Investors wanted explanations. Credit rating agencies wanted answers. Banks wanted reassurance. Every institution that had once trusted Enron now wanted proof that the company remained financially sound. Large trading businesses survive on credibility. Their counterparties assume contracts will be honored. Their lenders assume financial statements are reliable. Once those assumptions weaken, financing can disappear with astonishing speed. That is exactly what happened. Credit rating downgrades became a real possibility. Existing agreements contained provisions that could trigger additional obligations if those downgrades occurred. Financial pressure intensified almost daily. Executives searched desperately for a solution. But time was running out. One final lifeline appeared. Energy company Dynegy agreed in principle to acquire Enron. For employees, investors, and customers, the announcement felt like hope. Maybe the crisis could still be contained. Maybe the company could survive. But acquisitions require careful investigation. As Donaghy examined Enron's finances, the problems appeared far more severe than many had realized. The risks, simply too great. The proposed merger collapsed. And with it, so did Enron's last realistic chance of avoiding disaster. In December 2001, Enron filed for bankruptcy protection. At the time, it was the largest corporate bankruptcy in American history. The numbers were staggering. Thousands of employees lost their jobs almost overnight. Many also lost much of their retirement savings because their pension accounts were heavily invested in Enron stock. People who had spent years helping build the company watched their financial security disappear in weeks. Some delayed retirement indefinitely. Others lost college savings intended for their children. Behind every collapsing share price was a real family trying to understand how success had turned into catastrophe so quickly. Meanwhile, public anger intensified. Many executives had sold substantial amounts of stock before the collapse, although the legality and circumstances of individual transactions varied and were later examined separately through investigations and court proceedings. To ordinary employees who had continued believing in the company, the contrast was devastating. The institution they trusted most had failed them. But Enron wasn't the only giant about to fall. Attention quickly shifted to its external auditor, Arthur Andersen. Auditors exist for a simple reason. Investors need independent experts to examine financial statements and determine whether they fairly represent the company's financial condition. That trust is fundamental to modern capital markets. Yet Andersen faced growing criticism for failing to exercise sufficient professional skepticism while auditing Enron. Then another revelation made matters even worse. As investigations began, Andersen employees destroyed large quantities of Enron-related documents. The decision became a public relations disaster. Although the U.S. Supreme Court later unanimously overturned Arthur Andersen's criminal conviction because of flawed jury instructions, the damage had already been done. Clients fled. The firm's reputation collapsed. Thousands of employees, many with no involvement in the scandal, lost their careers. One of the most respected accounting firms in the world effectively disappeared. The fallout showed that reputational damage can be just as destructive as legal punishment. Congressional hearings soon followed. Regulators examined not only Enron's executives, but also auditors, investment banks, lawyers, analysts, and corporate directors. The deeper investigators looked, the more complicated the picture became. This wasn't one fraudulent transaction. It wasn't one dishonest executive. It wasn't one accounting mistake. It was an ecosystem, an environment where incentives often rewarded short-term appearances over long-term reality, where conflicts of interest weren't always challenged, where extraordinary complexity discouraged ordinary skepticism. Every safeguard had depended on someone else asking the difficult questions. Too often, nobody did. Federal prosecutors eventually pursued criminal cases against several senior executives. Andrew Fastow pleaded guilty to multiple charges and cooperated with investigators. Kenneth Lay was convicted on fraud and conspiracy charges but died before sentencing, causing his conviction to be vacated under the legal doctrine that applied at the time. Jeffrey Skilling was convicted on numerous fraud-related counts. After years of appeals, parts of his sentence were reduced, but significant convictions remained. These outcomes weren't the result of one dramatic courtroom revelation. They followed years of investigations, testimony, financial analysis, and legal proceedings involving millions of pages of documents. The collapse had taken months. Understanding it took years. Perhaps the most unsettling lesson wasn't hidden inside accounting rules. It was hidden inside human psychology. People often imagine fraud succeeds because nobody is paying attention. Enron suggested something far more uncomfortable. Sometimes everyone is watching. Analysts reviewed reports. Auditors examined records. Banks approved transactions. Board members attended meetings. Employees noticed inconsistencies. Journalists asked difficult questions. Yet almost everyone saw only one piece of an enormously complicated puzzle. Some trusted the experts. Some feared challenging successful leaders. Some assumed regulators had already verified everything. Others believed extraordinary success must simply require extraordinary complexity. It was a powerful reminder that intelligence alone doesn't eliminate blind spots. Sometimes it makes them harder to recognize. The scandal fundamentally changed corporate America. In 2002, lawmakers passed the Sarbanes-Oxley Act, introducing sweeping reforms to corporate governance and financial reporting. Senior executives became personally responsible for certifying the accuracy of financial statements. Public companies faced stricter internal control requirements. Audit committees gained greater independence and authority. Regulators increased scrutiny of accounting practices that previously received far less attention. The legislation didn't eliminate corporate misconduct. No law can eliminate human ambition, pressure, or temptation. But it changed expectations. Boards became more cautious. Auditors became more skeptical. Investors demanded greater transparency. The cost of ignoring warning signs became impossible to dismiss. More than 2 decades later, Enron is still taught in business schools around the world. Not because corporate fraud was invented there, and not because it was the last major financial scandal. It endures because it reveals something timeless. Every generation encounters companies that promise to rewrite the rules. Every financial boom produces stories that sound too good to question. Sometimes those stories are true. Innovation really does change industries. But history suggests that extraordinary claims deserve extraordinary scrutiny. Enron's rise was fueled by genuine creativity. Its collapse was accelerated by increasingly dangerous deception. Neither truth alone explains what happened. Only together do they tell the full story. In the end, Enron wasn't just about accounting. It was about incentives, about reputation becoming more important than reality, about confidence quietly transforming into overconfidence, about intelligence slowly giving way to arrogance. Most corporate scandals don't begin with a dramatic crime. They begin with a compromise that feels temporary, a projection that's just a little too optimistic, a warning that's postponed until next quarter, a difficult conversation that nobody wants to have. If success continues, repeating the compromise becomes easier. Soon, the exception becomes routine. The routine becomes culture, and the culture becomes almost impossible to challenge. By the time Enron collapsed, the numbers no longer reflected reality. But perhaps the deeper tragedy was that too many people had stopped asking whether they did. That may be Enron's greatest legacy. Not the bankruptcy, not the convictions, not even the billions of dollars that disappeared. Its most enduring lesson is that trust is the most valuable asset any institution possesses, and the easiest to lose. Balance sheets can be repaired. Buildings can be rebuilt. Companies can be renamed. But trust takes years to earn, and only moments to destroy. So whenever investors hear extraordinary promises, whenever executives insist they've rewritten the rules of business, and whenever complexity becomes a substitute for clarity, the shadow of Enron still lingers, quietly asking the same question that changed corporate America forever. If something appears too successful to question, is that precisely the moment we should start asking questions?